many investors who have joined in the last 3 to 4 years may not even know what we are talking about when we say market consolidation or correction or bear market, because they have not experienced even a single such environment. Now, these funds come very, very handy, particularly in a phase where valuations have run up, a lot of narratives are in the price, and the risk reward is not as favorable for equities as they were perhaps in the preceding period. 2, 3 points, specifically if you look at the context of last 2, 3 days, we are all undergoing large emotional shift. We are getting the realization that predicting anything is near impossible. And between Monday, yesterday, and today, the emotional shifts are, humongous, basically changing very, very fast. And in that context, this is where our experience has been that most of the mistakes are made, where we are driven more by emotion than by rationality or by, I would say, discipline. The asset allocation funds that I'm going to discuss, the core remains the same, that they all talk about diversification, and which comes handy in bear market or periods of consolidation, or where equity returns are not, above average, say not 25%. Now, the thing is, when we talk about these kind of funds, it looks odd to you or to your clients, because last 5 years we have not seen a single year where Nifty has delivered negative return, right? So many investors who have joined in the last 3 to 4 years may not even know what we are talking about when we say market consolidation or correction or bear market, because they have not experienced even a single such environment. Now, these funds come very, very handy, particularly in a phase where valuations have run up, a lot of narratives are in the price, and the risk reward is not as favorable for equities as they were perhaps in the preceding period. And we also know that the leadership of the market keeps changing. There's not one particular fund with or asset class category which outperform. You're all aware of this, but equities have been outperforming, but it was not the case in the previous decade. So many years where equity underperformed both fixed income and gold as an asset class. So for the longevity of our investors and client, for achieving their long-term wealth creation goals, it becomes very important that they remain invested for a longer period. And sometimes equity funds, pure equity funds, fails to deliver that, because the journey towards attaining those wealth goals becomes very bumpy if it is only about equity. Again, I'm saying difficult for people to accept and believe who have come recently, but anyone who is in the market for more than 5 years, say 10, 15, 20 years, they would appreciate this fact better. And as I said, in my experience, I've been tracking macro for almost 20 years now. I think predictions are generally tough. I don't think I can predict a lot of things, almost anything, and how asset classes would behave to a particular macro outcome is another challenge. For example, elections have not been as per the expectation, but no one with 100% certainty can tell you how will equity behave, how will fixed income behave, or how will gold behave. So asset classes behave differently in the same kind of macro environment. So even if you can predict everything about the macro, about the future, how asset classes will behave is another challenge. Now, if you just think about, I'm perhaps repeating the same point, um, that different time people do these performance chasing, because the recency bias is something which is always, in everyone's mind.
Tell me something, all these hybrid funds, when the market corrects, do they come in and invest more, and vice versa? Do they book out when markets become expensive? Do you have such reallocations in place? Is it event driven? Is it, driven by, say, certain time frames? How do you do these rebalancings is something we want to know.
So I didn't discuss much about Kavitha ji about Nippon's approach, but just about the way I do and I understand what others do. Typically, balance advantage, and for example, will always have um, a model behind it. Nobody would be doing subjectively that what they believe would be the next government and how the economy and earnings will shape up. And most models are having as a fulcrum valuations. Now, what valuation parameters they would have differs. Someone would have three or four different valuation parameters. Some will also involve interest rate and look at the difference between earnings yield and bond yield, and they combine. Um, so obviously, in a expensive market, you typically would have lesser allocation in equities. The challenge which I have seen in Indian context is that if you look at the 10-year rolling P ratio, forward P ratio Indian market, it has been an uptrending chart. So
Yes.
whatever your understanding about fair valuation has been, that is altering every 5 years, and you have been deceived. So unless you have these I would say these events like COVID, like some global events, you actually never got a chance to invest at a fair valuation zone, right? And people are actually narrowing the longer term averages. So people used to look at 20 years and 10 years. Now people look at 5-year averages to kind of deal with this problem. The other problem is that valuations, and I'm just taking one minute to explain this important part. Other point is that valuation per se has their own flaws because we are talking about Nifty or MSCI or any other index P ratio, for example, just or price to book ratio. But the constituents of these indices also changes. They changes materially. So today's Nifty has hardly any resemblance to Nifty of 2014 or 2009 or
True.
2004. So what kind of temperature I'm taking to determine whether there is a fever or not, right, or exuberance or not? Because the constituents are different. So if I today the constituents are more cyclical companies, even the fair long-term averages versus the long-term averages, today's valuations are actually expensive. And again, if I have more and more secular businesses, simple secular compounding businesses, by definition, because of the lower leverage and other things, they have to have higher valuation. Does not mean that is expensive, right? So I think there are flaws to it, and the way people kind of compensate for these known flaws for this otherwise important buy low, sell high signal is through combining it with other variables. So, for example, momentum or commodities or even currency. So strong dollar could be, copper could be something. Price momentum itself, market can remain irrational for quarters altogether, right? So you go by these supporting variables. This is what we do. Valuation, we try to make it more diversified, involve some bit of interest rate angle, and have faith in the process and follow that process. So it has to be subjective, can't be objective.
So does it involve some fund manager risk also? So the fund manager's risk is also there. Does that matter?
Not necessarily in terms of net equity allocation. The risk can come, positive or negative risk can come the way we design the portfolio. If I have the core portfolio is actively run, either for us it is in MAF or aggressive hybrid or BAF or anything. There, that is an additional source of alpha or risk the way we deliver. So that could be the additional angle or element to these kind of things.